Hi, I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree.
And I'm Jeff Weniger, Head of Equity Strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets. Hello and welcome back. It's Minds on the Markets. It's me and Mr. Flanagan there. And, this week we wrote in the written piece, which, by the way, is a one-pager. You can find it on the Wisdom Tree website. We do this every couple of weeks. We had Flanny opining on yield curves. And this has been one of those things that I've oftentimes been thinking about, Flanagan, is should I be looking at 2 years relative to 10 years? What does it mean implication-wise for yield curve steepeners, flatteners? Should I be looking at the long bond, bills, all these various things? And they can be moving in all different directions at any given point in time. So what were you saying this week?
So, obviously a lot of the client-facing events we've done, office hours, webinar calls, even in person, I'm getting asked a question a lot on our thoughts on the yield curve. And this certainly came in post-Jackson Hole, and as the Fed now, resuming rate cuts is going to be, I think, a key topic for fixed income investing. And even, I think, overall investing as well. Just, is there any messaging involved? So there's two primary yield curves. The first one is, and this is all for Treasury securities, it's the 2-year yield versus the 10-year yield. That's the one that tends to get the most attention. Right behind it, though, and arguably equally as important, is the 3-month T-bill and the 10-year note. And there is a difference between the two, even though you would think, okay, they're both monitoring, short duration or short-term maturities versus long. There are some differences, and they're not just nuances. And I think that's important. So when you're looking at actually the concept behind each of these yield constructs, a 2-year, right? The 10-year is going to be constant, right? So you're just looking at the front end, 3-month T-bill, 2-year. The 2-year is going to reflect not just Fed funds, but where the market perceives Fed funds is going to be down the road. So it's a little bit more of a projection of what the market is discounting. The 3-month T-bill 10-year construct is going to be more what's going on right now, right? Remember, 10-year constant, but that 3-month T-bill is going to reflect more often than not the actual Fed funds rate, or in the case if the Fed is just about to cut rates, what, say, would be that next rate cut move. So you will more than likely see differences between the two in terms of what we've seen, and that's already occurred this year.
And make sure that you're liking and subscribing so we can build up this YouTube page. And, of course, hit the visuals on the Wisdom Tree website if you want to see me and Flanagan writing these one-pagers. All right, Kevin, well, the other thing that's been going on as well is there's this push by Trump on the Federal Reserve, go ahead and cut rates. We want rates lower. Does that end up manifesting in, let's say, the 10-year T-note, the long bond being the 30-year bond? Do they necessarily follow yields down if Trump gets his way?
No. The 10-year, not all rates are going to respond in the same way or perhaps even the same direction. It all depends, right? So at this stage of the game, we have seen yields along the Treasury yield curve come down. Now, if Fed independence does get called into question, and let me tell we are not there yet. We are not there yet, okay? It makes for reading. It makes for social media or mainstream media kind of stories. But in terms of markets and the global investment community, we're not there yet. If we were to get there, it's probably a negative for something like the 10-year Treasury that could push yields higher because you want Fed independence or perceived independence, however way you want to look at it. So far this year, Jeff, what's interesting, it goes back to kind of like the question, that 2-year, 10-year curve has actually steepened by 20 basis points, where the 3-month T-bill 10-year curve has actually flattened by 20 basis points. So people ask us, well, what should we be looking at right now? Well, the 3-month T-bill is essentially your proxy for Fed funds versus the 10-year. And at this stage of the game, when you're looking at Treasury floating rate notes, which are referenced off of a 3-month T-bill, you are actually seeing a significant yield difference versus other parts of the curve, specifically, say, that 2-year note, which has already factored in 3 rate cuts. So you can pick up 50, 60 basis points in yield right now by focusing on Treasury floating rate notes. And if you think the Fed is going to be more aggressive and they're going to cut rates, say, more than 3 times, 5 times, 6 times in this current cycle, then that's where you would look to something in the area of that 1 to 3 year Treasury from specifically a performance perspective.
And if you're new to the channel, you may not know what I do know, which is that Kevin Flanagan is probably one of the top Fed Kremlinologists. We used to call these people that study the Soviet Union Kremlinologists. You're one of their Fed Kremlinologists in the biz. We've got a lot of seats moving around at the Fed. Jay Powell will be gone come the spring. What's the latest on who's going to be sitting in what seat, your forecasts for the next Fed chair, and so on?
I'll make this quick because we like to keep these nice and tight. So, right now it's been apparently narrowed down to former Fed Governor Warsh, current Fed Governor Waller, CEA, chairman at the time right now, Hassett. Those are the 3. I think either one or any of them would probably be a good choice. And I think it's completely different when you sit at the table at an FOMC meeting versus perhaps what you're saying to the press. Completely different.
All right. Well, that's Kevin Flanagan, and I'm Jeff Weniger. We're from the ETF house, Wisdom Tree. Thank you for investing. Thank you for subscribing to the channel, and thank you for telling your friends about this. Have a good day.
Take care.